Before we begin, a quick and important disclaimer. This video provides educational information regarding the historical trends and academic discourse surrounding divorce proceedings in the United States. The content presented here is for educational and entertainment purposes only and does not constitute legal, financial, or psychological advice. Divorce laws vary significantly by state and individual circumstances. You should not act or refrain from acting on the basis of any content included in this video without seeking the appropriate legal or professional advice from a licensed attorney or qualified expert in your specific jurisdiction. Please conduct your own due diligence before making any significant life decisions. Statistically, in the United States, a marriage ends every 36 seconds. That is nearly 2,400 divorces per day. And by the time you finish this 10-part masterclass, thousands of women across the country will have begun the most significant legal and financial restructuring of their lives. Yet, despite how common this transition is, the academic and sociological data suggest that women often face a disproportionate divorce penalty when it comes to long-term wealth accumulation and career trajectory. For decades, the narrative has focused on the emotional fallout, but the data tells a much more complex story about structural inequality, the nuances of no-fault legislation, and the critical importance of strategic positioning before the first filing is ever served. We are entering a new era of academic discourse where divorce is no longer viewed merely as a personal failure, but as a complex legal and economic pivot that requires the precision of a corporate merger. If you feel like the system is designed to be opaque, you are correct. And if you believe that simply playing fair ensures a fair outcome, the historical case studies we will examine today suggest otherwise. This masterclass is designed to bridge the gap between emotional upheaval and intellectual empowerment. We are solving the problem of information asymmetry. In legal theory, information asymmetry occurs when one party has more or better information than the other, often leading to an imbalance of power. For many women in the U.S., this manifests as a lack of clarity regarding marital asset characterization, the long-term impact of tax liabilities on settlements, and the evolution of alimony standards across various state legislatures. Today, we begin part one of a deep-rooted investigation into the mechanics of American divorce. We are going to dismantle the myths of the courtroom, analyze the socioeconomic data of post-divorce outcomes, and provide you with a comprehensive framework for understanding your standing in a system that was built on centuries of evolving common law. To understand where a woman stands today, we must first examine the historical shift from fault-based divorce to the modern no-fault era. Prior to the 1970s, a spouse generally had to prove fault, such as adultery, cruelty, or abandonment, to obtain a dissolution of marriage. This created a specific power dynamic where the innocent party often held significant leverage in settlement negotiations. However, with the passage of the Family Law Act in California in 1969, which later swept across the country, the requirement for fault was largely abolished. Academics have noted that while this provided an exit ramp for many in unhappy or abusive situations, it also inadvertently stripped away certain financial protections that were previously tied to marital conduct. We see this reflected in various sociological studies showing that in the immediate decades following the no-fault revolution, the standard of living for many women dropped significantly post-divorce compared to their former spouses. Let's look at a case study often cited in sociology of law: the gendered wealth gap in marital dissolution. Researchers have identified that non-monetary contributions, such as child-rearing, domestic management, and supporting a spouse's career, are frequently undervalued in the traditional legal calculus of asset division. In a community property state like Texas or California, the law assumes a 50-50 split of assets acquired during the marriage. However, a 50% split of a bank account does not account for the human capital loss of a woman who may have stepped out of the workforce for a decade. The potential outcome of a simple 50-50 split often ignores the reality of earning capacity. If one spouse spent the marriage building a medical practice while the other managed the home, the doctor retains 100% of their future high-income potential, while the domestic manager retains only 50% of the past savings. This is why academic discourse now focuses heavily on the equitable distribution model used in the majority of U.S. states, which allows judges to consider more factors than just who bought what. Understanding the difference between community property and equitable distribution is the first step in this masterclass. In the 41 equitable distribution states, the court is not required to divide property equally. Instead, they look at what is fair. This introduces a high level of subjectivity, and requires a sophisticated understanding of how to present one's contributions to the marriage. Factors that courts typically analyze include the length of the marriage, the age and health of both parties, the income or property brought into the marriage by each party, and the standard of living established during the marriage. For example, if we look at historical trends in New York or Florida, the court may award a larger share of assets to a spouse with lower earning potential to prevent them from becoming a ward of the state. This is a crucial distinction that many people overlook when they begin the process. Furthermore, we must address the valuation gap. In high-asset academic circles, the most contested area is often not what is owned, but what it is worth. This includes the valuation of unseen assets like pensions, 401k plans, stock options, and even professional degrees or celebrity goodwill in some jurisdictions. A common pitfall identified in legal case studies is the tax time bomb. If a settlement awards one spouse a house worth $1 million and the other spouse $1 million in a traditional IRA, they have not received an equal settlement. The IRA carries a future tax liability that the house, depending on capital gains exemptions, may not. Without a deep dive into the tax-adjusted value of assets, a woman may inadvertently sign away 20% to 30% of her net worth to the IRS. We are also going to explore the shifting landscape of spousal support, colloquially known as alimony. The academic trend over the last 20 years has moved away from permanent alimony toward rehabilitative alimony. The legislative intent behind this shift is to provide support only for the period necessary for the recipient to become self-sufficient. This has massive implications for women who have been out of the professional world for 20 or 30 years. The data shows that the gray divorce demographic, those over the age of 50, is the fastest growing group of divorcees in the U.S. For this group, the rehabilitative model can be particularly challenging, as re-entering a competitive, age-biased job market at 55 is statistically different than doing so at 25. This part 1 is about setting the foundation of reality versus expectation. You will learn how to categorize assets into separate versus marital, a distinction that determines whether an inheritance or a premarital business is on the table or off-limits. We will discuss the dissipation of assets, where one spouse spends marital funds on non-marital activities, and how forensic accounting, a staple of academic legal investigation, can be used to track these leaks. This masterclass is your guide through the labyrinth of the U.S. legal system, focused on data, historical precedent, and the structural realities of the 21st century. We are moving beyond the surface-level advice found in magazines and entering the realm of high-level academic strategy. Prepare to change the way you view the legal contract of marriage and the strategic dissolution of that contract. To master the strategic dissolution of a marital contract in 2026, we must first confront the foundational pillar of American family law, the classification of property. In the academic discourse of domestic relations, this is known as the characterization phase. Imagine a woman named Sarah living in a suburb of Charlotte, North Carolina. Sarah has been married to her husband, Michael, for 15 years. Over that time, they have acquired a family home, a vacation property in the mountains, several investment accounts, and Sarah has maintained a small boutique consulting firm she started 2 years before the wedding. In the eyes of the court, Sarah's entire financial world is now subject to a microscopic audit. The first step in this masterclass is the surgical separation of what is marital versus what is separate. Separate property generally includes anything owned by one spouse before the marriage, or property acquired during the marriage by gift or inheritance. Marital property, or community property depending on the state, encompasses nearly everything else earned or acquired during the union. However, the complexity arises when these two categories bleed into one another, a process legal scholars call commingling. If Sarah took $5,000 of her premarital inheritance and used it as a down payment on the family home, or if she deposited her consulting fees into a joint checking account used to pay the mortgage, she has entered the danger zone of transmutation. Transmutation occurs when separate property loses its individual identity and becomes marital property through the intent or actions of the parties. Historical trends in states like New York and Florida show that once an asset is commingled, the burden of proof shifts heavily to the spouse claiming the separate interest. Sarah would need a meticulous paper trail, a process called tracing, to prove exactly where those original funds came from, and that she never intended them to become a gift to the marital estate. Without this documentation, the court often defaults to the assumption that the asset is marital, potentially diluting Sarah's premarital wealth by half. Beyond physical assets like real estate and bank accounts, we must address the valuation of professional degrees and business goodwill. In the academic study of law, particularly in jurisdictions like New York, the concept of enhanced earning capacity has been a point of intense debate. Imagine if Michael spent the marriage attending medical school, while Sarah worked 2 jobs to pay the tuition. In some historical legal frameworks, that medical degree was viewed as a marital asset because it was acquired through joint effort and expected to provide future financial benefits to the unit. While many states have moved away from valuing the degree itself, they often compensate the supporting spouse through a larger share of other assets or through specialized alimony structures. This leads us to the critical analysis of the valuation date. The value of a stock portfolio or a family home can fluctuate wildly between the date of separation, the date of filing, and the date of the final judgment. In a volatile 2026 economy, a 3-month delay in a court hearing could mean a 6-figure difference in the value of a tech-heavy investment account. Strategic academic discourse suggests that understanding your state's specific rules on valuation dates is just as important as the valuation itself. Does your state value assets at the time of the trial or the time of the split? This single detail can dictate whether a spouse benefits from or is penalized by market movements occurring during the litigation process. We must also examine the often overlooked reality of the marital debt. In the United States, marital property is not just about what you own, it is about what you owe. Under the doctrine of necessaries or general community debt rules, both spouses may be held responsible for debts incurred during the marriage, even if only one spouse's name is on the credit card or loan document. Historical case studies highlight the risk of predatory debt, where one spouse racks up significant liabilities in anticipation of a filing. Academic researchers emphasize the importance of a credit freeze and a comprehensive debt audit the moment a dissolution is contemplated. This is not about being cynical. It is about the mathematical reality of your future balance sheet. If the court divides $60,000 in credit card debt equally, but only one spouse has the income to pay their share, the other spouse may find their credit score destroyed by the default of the former partner. Let's transition into the socioeconomic data regarding the standard of living factor. When a court determines spousal support, they frequently cite the goal of maintaining the standard of living established during the marriage. However, academic studies consistently show that it is mathematically impossible for 2 separate households to maintain the same standard of living on the same total income that previously supported one household. There are now 2 mortgages or rents, 2 utility bills, and 2 sets of insurance premiums. This creates what sociologists call the squeeze effect. For a woman who has been the primary caregiver, the legal argument must shift from a plea for fairness to a data-driven presentation of future needs. This involves creating a lifestyle analysis. A lifestyle analysis is a forensic accounting tool that reconstructs the family's spending patterns over the last 3 to 5 years. It accounts for everything from country club dues and private school tuition to the average cost of groceries and dry cleaning. In 2026, this also includes digital assets and recurring subscriptions that often fly under the radar. By presenting a judge with a granular, evidence-based report on what it actually costs to live, a woman moves the conversation away from vague estimates and toward a concrete financial requirement. We must also consider the hidden assets phenomenon. In high-stakes academic discourse, we discuss the tax return analysis. A savvy observer looks for inconsistencies between reported income and the visible lifestyle. Are there unexplained transfers to offshore entities? Are there loans made to friends that are actually disguised distributions of marital cash intended to be returned after the divorce is final? Historical trends suggest that nearly 30% of high-net-worth divorces involve some level of asset concealment. The use of forensic experts to perform a lifestyle audit is often the only way to ensure the pool of marital property is complete before the division begins. The role of the vocational expert is another layer of this masterclass. In many modern U.S. divorce cases, if a woman has been out of the workforce, the opposing counsel may hire a vocational expert to testify that she is underemployed. This expert will provide data on available jobs in her area, her presumed earning capacity based on past education, and how quickly she could theoretically return to a high-paying role. Academic strategy requires a counter-approach, documenting the obsolescence of skills. If Sarah was a software developer in 2010 but has been a stay-at-home mother since then, her skills in the 2026 tech market may be functionally non-existent without significant retraining. Proving this rehabilitative gap is essential for securing the support necessary to bridge the transition. As we conclude this second deep dive, We have moved through the characterization of property, the dangers of commingling, the volatility of valuation dates, and the looming shadow of marital debt. We have seen how a lifestyle analysis and vocational evidence form the backbone of a modern legal strategy. But even if you identify every cent in every debt, there is a silent partner in every divorce settlement that can take a massive bite out of your future: the Internal Revenue Service. In the next part of this masterclass, we will peel back the curtain on the taxation of trauma. We will analyze why a house is not always equal to a bank account, how the 2017 Tax Cuts and Jobs Act permanently altered the math of alimony, and the specific ways the 2026 tax environment creates hidden liabilities in retirement accounts. If you don't understand the tax basis of the assets you are fighting for, you might win the battle in court only to lose the war when April 15th rolls around. We are just getting started. In the academic study of domestic dissolution, there is a recurring phenomenon known as the ghost at the table, the Internal Revenue Service. It is the silent third party in every negotiation room in the United States, and in 2026, its presence is more impactful than ever. To navigate this, we must move beyond the face value of assets and into the territory of after-tax reality. Imagine a woman named Jennifer in Scottsdale, Arizona. As she nears the finalization of her divorce, the settlement looks clean. Jennifer gets the family home, valued at $1.2 million with $600,000 in equity. Her husband, David, keeps his 401k and brokerage accounts, also totaling $600,000. On paper, it is a perfect 50-50th split. But in the realm of high-level financial strategy, this is a mathematical illusion. Jennifer has just accepted what academics call a low-basis asset, while David has retained high liquidity or tax-advantaged assets. If Jennifer decides to sell that home in 2 years, she may face a massive capital gains tax bill that David will never have to pay on his cash. Understanding why requires a deep dive into the 2026 tax code. Let's start with the principal residence exclusion. Under Section 121 of the Internal Revenue Code, a single filer can exclude up to $250,000 of gain from the sale of their primary home, provided they have owned and lived in it for 2 of the last 5 years. Married couples filing jointly can exclude $500,000. In 2026, with home prices in many U.S. metros having appreciated significantly over the last decade, Jennifer's $600,000 in equity might represent a $700,000 gain over the original purchase price. If Jennifer sells the house as a single woman post-divorce, she only gets the $250,000 exclusion. She will owe capital gains tax on the remaining $450,000. At a 2026 long-term capital gains rate of 15% or 20%, plus potentially the 3.8% net investment income tax, Jennifer could be looking at a tax bill exceeding $100,000. Suddenly, her $600,000 in equity is actually worth less than $500,000. Meanwhile, David's 401k grows tax-deferred. This is the difference between a gross settlement and a net settlement. +1. Now, consider the alimony revolution brought about by the Tax Cuts and Jobs Act, which remains the law of the land in 2026. For any divorce finalized after December 31, 2018, alimony is no longer deductible for the payer and is no longer taxable income for the recipient at the federal level. While this sounds like a win for women receiving support, historical trends show it has fundamentally shifted the bargaining power. In the pre-2019 era, a high-earning spouse could afford to pay more in alimony because the government effectively subsidized the payment through a tax deduction. In 2026, every dollar David pays Jennifer is a post-tax dollar. If David is in the 37% tax bracket, he has to earn nearly $1.60 to send Jennifer $1. As a result, payers are fighting harder to lower alimony amounts, and courts have adjusted their formulas downward to reflect the payer's increased tax burden. Academic discourse suggests that women must now focus on securing non-modifiable or lump sum alimony structures to protect against future legislative shifts or changes in the payer's income. We must also address the mechanics of the QDRO, or Qualified Domestic Relations Order. This is a highly specialized legal instrument required to divide a private sector retirement plan like a 401k or a pension without triggering immediate taxes or early withdrawal penalties. Many women make the mistake of assuming the divorce decree itself is enough to split the account. It is not. Without a state court-approved QDRO that is also accepted by the plan administrator, the money stays exactly where it is. +1. Imagine if Jennifer needs $50,000 from David's 401k to pay for her new apartment and legal fees. Under a specific provision of the tax code related to QDROs, an alternate payee, the spouse, can take a one-time cash distribution from a 401k without the 10% early withdrawal penalty, even if they are under age 59 and a half. However, and this is the detail that catches people, that distribution is still treated as ordinary income. If Jennifer isn't careful, that $50,000 help could push her into a higher tax bracket and leave her with only $35,000 after federal and state withholdings. The academic discourse also warns about the IRA trap. Unlike a 401k, an individual retirement account does not require a QDRO. It only requires a transfer incident to divorce. But here is the catch. The 10% penalty exception that exists for QDROs does not apply to IRAs. If Jennifer takes a cash distribution from an IRA she received in the divorce before she is 59 and a half, she will likely owe both the income tax and the 10% penalty. This is why forensic financial planning is non-negotiable. You must know exactly which bucket of money you are reaching into. Plus 2. Beyond retirement, we have the 2026 landscape of child support and the head of household filing status. While child support remains tax neutral, neither deductible nor taxable, the right to claim the child as a dependent has massive implications. The child tax credit and the ability to file as head of household provide a higher standard deduction and more favorable tax brackets. In a typical U.S. divorce, the custodial parent, the one with whom the child spends more than half the nights of the year, is the one entitled to these benefits by default. However, many settlements involve waiving these rights via IRS Form 8332. If Jennifer gives away the dependency exemption to David without getting a corresponding increase in child support or assets, she is effectively handing him thousands of dollars in tax savings every year while increasing her own tax liability. Plus 1. Step by step, a strategic tax audit during divorce looks like this. First, determine the cost basis of every asset. Is it a house bought for $200,000 now worth $800,000? Or is it a brokerage account with $600,000 in cash? The cash is worth more. Second, calculate the tax-affected value. Multiply the projected gain by your projected post-divorce tax rate. This is your true number. Third, verify the vesting schedule of any stock options or restricted stock units, RSUs. In 2026, many tech-heavy marital estates include unvested RSUs. If the divorce is finalized before they vest, who pays the tax when they eventually hit the account? Without a specific tax indemnification clause in the settlement, the recipient might be stuck with a tax bill they can't afford. Case studies from recent years show that the hidden tax is often the single biggest reason for post-divorce financial instability. The academic community refers to this as the settlement regret factor. Women who focus on the immediate monthly cash flow without considering the long-term tax erosion of their capital often find themselves house-rich but cash-poor. As we deepen this deep dive, we have to look at what happens when the negotiations stall. What happens when the collaborative approach fails, and you find yourself in a high-conflict litigation scenario? The tax math is the foundation, but the courtroom is where the narrative is built. In the next part, we will explore the psychology of the litigated divorce. We will analyze the data on legal abuse and guerrilla tactics used in modern U.S. courtrooms to drain a spouse's resources, and more importantly, how to build a defensive perimeter that protects both your mental health and your legal standing. The numbers are just the beginning. Now we look at the strategy of the battle. The transition from financial auditing to the theater of high-conflict litigation is where many women experience the most profound psychological and economic strain. In the academic discourse of family law, this is often referred to as the attrition phase. The objective in high-stakes domestic litigation is frequently not a swift resolution, but rather the exhaustion of the opposing party's emotional and financial reserves. To navigate this, we must analyze the mechanics of legal maneuvering through the lens of a defensive perimeter. Imagine a woman named Maria in Chicago, Illinois, entering the year 2026. Maria's spouse has significant control over the marital income and has begun a campaign of what sociologists call legal abuse. This involves filing repetitive motions, refusing to provide discovery documents, and using the court system as a tool for continued intimidation. In this scenario, Maria's first defensive layer is the understanding of pendant light motions. Pendant light is a Latin term meaning awaiting the litigation. In many U.S. jurisdictions, a woman can petition the court for temporary orders that dictate the rules of engagement, while the divorce is pending. These orders can cover temporary spousal support, child custody, and perhaps most importantly, the payment of attorney fees. Academic case studies show that the funding gap is the primary reason women settle for less than their equitable share. By filing a motion for interim counsel fees, Maria can request that the court order her higher-earning spouse to pay her legal retainers. This is a critical historical trend in family law designed to level the playing field, ensuring that one party cannot simply outspin the other into submission. However, the effectiveness of this strategy depends on the documentation of the financial disparity. Step by step, Maria must provide the court with an affidavit of net worth that mirrors the forensic lifestyle analysis we discussed in Part 2. She must show a clear gap between her liquid assets and the projected costs of a litigated trial. In 2026, the cost of expert witnesses, including forensic accountants, child custody evaluators, and vocational experts, can easily reach into the tens of thousands of dollars. Without a pendant light order for fees, Maria's defensive perimeter is compromised before the first substantive hearing. We must also explore the data-driven reality of discovery warfare. Discovery is the formal process of exchanging information, and in high-conflict cases, it is often weaponized. Imagine if Michael, Maria's spouse, responds to every request for bank statements with a dump of 10,000 disorganized digital files, or conversely, claims that no such records exist. This is known as stonewalling. Academic strategy suggests that the countermove is the use of subpoenas directed at third parties. Instead of asking Michael for the records, Maria's legal team issues subpoenas directly to the financial institutions, employers, and credit card companies. This removes the gatekeeper power from the spouse and places the burden of accuracy on neutral third-party corporations. The psychological dimension of this battle involves the strategic use of conflict. Sociological researchers have identified a pattern where high-conflict personalities use gaslighting within legal pleadings. They might file declarations that paint a distorted picture of Maria's parenting or her financial contributions, hoping to trigger an emotional reaction. When Maria reacts with anger or desperation in court, it reinforces the narrative the spouse is trying to build. The defensive perimeter here is radical disengagement. This means viewing every legal document not as a personal attack, but as a data point in a chess match. Historical case studies indicate that the most successful outcomes for women in these high-pressure scenarios occur when they maintain a business-like demeanor, focusing entirely on the evidentiary record rather than the emotional provocation. Furthermore, we must address the parental gatekeeping and alienation discourse that often dominates litigated divorces in 2026. In the U.S., the best interests of the child standard is the North Star for custody decisions. However, this standard is highly subjective. Academic research suggests that courts are increasingly moving toward 50-50 shared parenting as a default starting point. While this aims for equality, it can be problematic in cases where there is a history of coercive control. Maria must be prepared for the GAL or guardian ad litem. This is an attorney appointed by the court specifically to represent the children's interests. The GAL will interview Maria, Michael, teachers, and doctors. To protect her standing, Maria must demonstrate co-parenting competence. This involves documenting every attempt to facilitate a relationship between the children and their father, even in the face of conflict. In the eyes of a 2026 judge, the parent who is seen as the facilitator often holds the higher moral and legal ground. Let's look at a case study regarding digital footprints in litigation. In 2026, your digital life is your most vulnerable flank. Historical trends show an explosion in the use of social media posts, private text messages, and even geolocation data from fitness trackers as evidence in divorce court. Imagine if Maria claims she cannot work due to a health condition, but her public social media shows her on a strenuous hiking trip. Or imagine if Michael claims he was at work, but his car's GPS history shows him at a casino. A deep dive masterclass in defensive strategy requires a digital content audit. This is the process of securing your accounts, changing passwords to avoid unauthorized access, and understanding that anything written in a private text message should be viewed as something that will eventually be read aloud by a judge. Another critical element of the defensive perimeter is the security of residence. If Maria stays in the marital home, she must understand the legalities of exclusive possession. In many states, simply because both names are on the deed does not mean both parties have a right to be there during a high-conflict divorce. If there is a detrimental environment for the children or a history of domestic turbulence, A woman can seek a court order for exclusive possession, effectively removing the spouse from the home until the divorce is final. This is not an eviction in the traditional sense, but a temporary protective measure to maintain the status quo and prevent further escalation. As we examine the attrition strategy, we have to discuss the role of mediation versus trial. While academic discourse often praises mediation as a peaceful alternative, in high-conflict cases where there is a significant power imbalance, mediation can sometimes be another tool for coercion. In 2026, shuttle diplomacy mediation is a common historical trend where the parties stay in separate rooms, and the mediator moves between them. This prevents direct intimidation. However, a woman's strategy must be mediate from a position of trial readiness. This means you only enter mediation when you have already completed discovery and have a firm grasp of the potential outcomes at trial. You cannot negotiate a fair deal if you are afraid of the courtroom. The defensive perimeter is about controlling the flow of information, securing the funds to fight, and protecting the emotional narrative. But what happens when the legal battle reveals a much darker financial reality? What if the wealth you thought you were fighting for is built on a house of cards? In the next part, we will explore the forensic investigation of business interests. We will analyze how to value a private company, how to pierce the corporate veil when a spouse hides money in a shell corporation, and the academic methods for identifying premeditated financial dissipation. The courtroom battle is fought with motions, but the war is won with the evidence of where the money went. We are moving from the perimeter into the heart of the corporate marital estate. Entering the heart of the corporate marital estate requires a shift from general accounting to forensic scrutiny. In the academic discourse of high net worth dissolution, the marital home is often a distraction from the true engine of wealth, the closely held business. Imagine a woman named Elena in Austin, Texas, in 2026. Her husband, Marcus, owns a successful software-as-a-service company. For a decade, Elena has seen the lifestyle this business provided: the international travel, the luxury vehicles, the private school tuitions. But as soon as the divorce petition is filed, Marcus presents a financial statement claiming the business is experiencing a downturn, carries heavy debt, and is essentially worth very little. This is the beginning of the valuation war. The first step in analyzing a business interest is determining the standard of value. In most U.S. jurisdictions, the court looks for fair market value, which is defined as the price at which the property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or to sell and both having reasonable knowledge of relevant facts. However, some states use intrinsic value or value to the owner. The difference can result in millions of dollars in the final distribution. Academic researchers highlight three primary approaches to valuation: the asset-based approach, the market approach, and the income approach. The asset-based approach is often the floor of the valuation. It calculates the net value of the company's physical assets, equipment, real estate, and inventory, minus its liabilities. While straightforward, it rarely captures the true value of a service-based or tech company where the value lies in intellectual property or recurring revenue. This is where the income approach becomes critical. This method, specifically the capitalized earnings or discounted cash flow analysis, looks at the historical earnings of the business and projects them into the future, adjusting for risk. If Marcus's company is generating $2 million in annual profit, a forensic accountant will apply a multiple to that number, based on historical trends in the software industry. If the multiple is 5, the business is valued at $10 million. Marcus may argue for a multiple of 2, citing market volatility in 2026. Elena's expert must counter with data showing the stability of the company's specific niche. A pivotal concept in this deep dive is personal goodwill versus enterprise goodwill. Enterprise goodwill is the value associated with the business entity itself, its brand, its location, its recurring customer base. Personal goodwill is the value directly attributable to the individual owner's reputation, skills, or personal relationships. In many U.S. states, personal goodwill is considered separate property and is not divisible in a divorce, while enterprise goodwill is a marital asset. If Marcus can convince the court that the business only succeeds because of his personal genius, he might shield a significant portion of the company's value from Elena. The academic counter-strategy involves proving that the company has a management team, a recognized brand, and systems that would allow it to function, even if Marcus were not there. We must also address the technique known as piercing the corporate veil. Often, a spouse will use a business as a personal piggy bank, paying for non-business expenses like family vacations, home renovations, or personal staff through the company accounts. In academic legal theory, this is the commingling of corporate and personal identities. By identifying these add-backs, a forensic accountant can artificially inflate the true income of the business. If the company paid for $100,000 of the family's personal lifestyle last year, that $100,000 is added back into the profit column for valuation purposes. This process requires a line-by-line audit of general ledgers and credit card statements, looking for patterns of disguised distributions. Case studies in 2026 frequently point to the use of shell companies or tiering. Marcus might have his primary company pay a consulting fee to a secondary LLC that he secretly controls. This effectively lowers the profit of the main company, while stashing cash in an entity that Elena may not even know exists. The discovery process must therefore include a search for any entity where Marcus has an ownership interest or signatory authority. Researchers emphasize the follow the cash rule. Every dollar that leaves the main business must be accounted for at its destination. If a payment goes to an entity with no physical office and no employees, it is a red flag for premeditated financial dissipation. Furthermore, we must consider the buy-sell agreement. Many private companies have governing documents that state a spouse cannot own shares, or that the shares must be valued at book value in the event of a divorce. While these agreements are legally binding between the partners, many U.S. courts in 2026 have ruled that they do not necessarily bind the court's valuation for the purpose of an equitable split. The court may still value the business at its true fair market value and order Marcus to buy out Elena's interest using other marital assets, like the family home or retirement accounts. This is known as an offset. Step by step, the forensic investigation of a business interest involves: first, the request for a 5-year look-back of tax returns, profit and loss statements, and balance sheets. Second, the identification of all perks or personal expenses paid by the business to normalize the income. Third, the selection of the appropriate capitalization rate or multiple based on 2026 economic data. Fourth, the analysis of accounts receivable. A common tactic is for a business owner to delay sending out invoices or to prepay future expenses just before the valuation date to make the business look less profitable on paper. Another layer of the corporate marital estate is the double-dipping controversy. This occurs when a court treats a business's income as both an asset to be divided and a source of income for alimony. For example, if the business is valued based on its future income stream and Elena receives half of that value in the property split, can she also ask for alimony based on that same income? Academic discourse is split on this, and different U.S. states have different rules. In states like Ohio or Virginia, courts are generally careful to avoid double-dipping, whereas in others, the distinction is less rigid. Understanding your state's stance on this double counting is essential for a woman to manage her expectations regarding the total financial package. As we conclude this analysis of business interests, we see that the complexity of the corporate divorce is not just in the math, but in the access to information. If Marcus controls the books, he controls the initial narrative. Elena's success depends on her ability to use the legal tools of discovery to force transparency. But even if the business is valued accurately and the assets are identified, there is one final hurdle that many women are completely unprepared for. What happens when the assets aren't just in a bank account or a business, but are tied up in the future? In the next part, we will explore the golden handcuffs of executive compensation. We will deep dive into the valuation of unvested stock options, restricted stock units, RSUs, and the cyber assets of 2026, including cryptocurrency portfolios and digital IP. If you think a business is hard to value, wait until you see how the law handles wealth that hasn't even been earned yet. The future is where the biggest battles are fought. The battle for the future begins with understanding the nature of contingent assets. In the modern American economy of 2026, wealth is increasingly tied to what academics call the golden handcuffs, compensation structures designed to keep high-value employees anchored to their corporations through future promises rather than current cash. For women navigating a divorce, these assets represent a significant portion of the marital estate, yet they are often the most misunderstood. Imagine a woman named Chloe in Seattle, Washington. Her husband, James, is a senior executive at a major cloud computing firm. His base salary is substantial, but the true wealth lies in his restricted stock units, or RSUs, and his non-qualified stock options. RSUs are essentially a promise from an employer to grant the employee shares of company stock at a future date, provided certain conditions are met, usually remaining employed through a vesting period. In 2026, many tech sector contracts utilize a 4-year vesting schedule with the 1-year cliff. If James was granted 10,000 shares 2 years ago, but they do not fully vest for another 2 years, how does a court in 2026 divide that value? This is where we apply the time rule formula, often referred to in academic legal circles as the Kofer or Hunt formula. The time rule formula creates a fraction to determine the marital portion of the stock. The numerator is the amount of time James worked for the company during the marriage while the options were being earned, and the denominator is the total time from the date of the grant to the date of vesting. Historical trends in states like Washington and California show that even if the stock vests after the divorce is final, a portion of that value is considered marital property because the labor that earned it occurred during the marriage. For Chloe, this means her legal team must perform a granular analysis of every grant date, every vesting date, and the specific language of the grant agreements. Now, consider the volatility of the 2026 market. If the stock is currently trading at $100 per share, those 10,000 units are worth $1 million. But if the market dips by the time they vest, that value could vanish. Conversely, if the company goes public or is acquired, the value could quadruple. Academic Discourse suggests 2 primary methods for distribution: the deferred distribution method or the immediate offset. In a deferred distribution, the court orders that when the stock eventually vests, a percentage of the proceeds, net of taxes, is paid to the former spouse. This shares the risk of market fluctuation between both parties. In an immediate offset, the spouse keeping the stock pays the other spouse the current value using other assets, such as cash or home equity. This provides the non-employee spouse with certainty, but requires a deep understanding of the present value discount. We must also address the taxability of future wealth. When James's RSUs vest, they are treated as ordinary income, not capital gains. This means the IRS will withhold federal and state taxes, often at the highest marginal rate, before James ever sees a single share. If Chloe's settlement says she gets 50% of the shares, she must ensure the language specifies 50% of the net shares after taxes. If the decree is poorly drafted, James might be stuck paying the full tax bill on Chloe's half, or Chloe might receive a gross amount that she later owes taxes on, leading to a financial shortfall. Beyond traditional stocks, the 2026 landscape is dominated by the digital frontier. This includes cryptocurrency portfolios, non-fungible tokens representing intellectual property, and even digital real estate in emerging meta ecosystems. Case studies from the last 3 years highlight the cold wallet trap. If James has moved marital funds into a decentralized hardware wallet, the asset is virtually invisible to traditional bank audits. Forensic digital analysts are now a standard part of high-stakes divorce teams. They use blockchain analytics to trace on-ramps and off-ramps, the moments where traditional currency was converted into digital assets. Historical trends indicate that while the assets themselves may be encrypted, the bank records showing the initial purchase are not. Step by step, the audit of cyber assets involves: first, a request for all digital wallet addresses and exchange account statements. Second, a cross-reference of the lifestyle analysis against reported income to find missing cash that may have been diverted to crypto. Third, the valuation of the assets on a specific trigger date. In a market that can move 20% in a single afternoon, the choice between the date of filing and the date of trial can represent a fortune. Let's pivot to another form of future wealth: the defined benefit pension. While 401(k)s are more common, many public sector employees, teachers, and career military personnel still have traditional pensions. Academic researchers call this the survivor benefit gamble. In a divorce, a woman can be awarded a portion of her husband's future pension through a QDRO. However, if James passes away after the divorce but before he starts collecting, Chloe's interest might vanish unless she is specifically named as the surviving spouse for that portion of the benefit. This requires a specific election that must be made at the time of the divorce. Case studies show that thousands of women lose their retirement security every year because their legal counsel failed to secure the survivor benefit clause. Furthermore, we must examine the concept of human capital as a future asset. In some academic legal theories, particularly those discussed in the mid-2020s, there is a push to recognize the loss of career opportunity as a compensable item. If Chloe quit her law career to support James's executive rise, she didn't just lose 10 years of salary, she lost 10 years of seniority, networking, and compound skill growth. While most U.S. courts do not treat lost career potential as a divisible asset like a house, they do use it as a heavy weight in the alimony calculus. The data shows that the longer the marriage, the more likely a court is to award compensatory support to bridge this gap. We are also seeing a rise in the valuation of digital IP and personal brand. If James has a significant professional following or a monetized industry newsletter, that digital presence has a value based on future ad revenue and sponsorship potential. Academic Discourse in 2026 treats this similarly to business goodwill. If the brand was built during the marriage, the income it generates is a marital product. Proving the value requires a social media forensic expert who can project future earnings based on engagement metrics and historical growth. This part of the masterclass reveals that the most valuable assets in a 2026 divorce are often invisible to the naked eye. They are locked in vesting schedules, encrypted in digital ledgers, or hidden in the fine print of pension survivor elections. For Chloe, the potential outcomes of her divorce will be determined not by what she can see in the joint checking account today, but by her ability to map out the next 20 years of James's earning trajectory. But what happens when you've identified the assets, the taxes, and the future wealth, only to realize that your partner has been leading a parallel life? What if the financial discrepancies aren't just about stock options, but about alternative obligations? In the next part, we will explore the sociology of the secret estate. We will deep dive into the legal mechanics of marital waste and dissipation, including how courts handle the discovery of undisclosed debts, secondary families, and the long-term exit plan that one spouse may have been funding for years behind your back. The discovery process is about to get much more personal. The sociological study of the secret estate focuses on a phenomenon known as financial infidelity, which researchers have found to be a significant precursor to formal marital dissolution. In the academic discourse of family law, this often manifests as the dissipation of marital assets. Dissipation occurs when one spouse uses marital funds for a purpose unrelated to the marriage at a time when the relationship is undergoing an irreconcilable breakdown. To understand the gravity of this, imagine a woman named Sophia in Miami, Florida, in 2026. For 3 years, her husband, Robert, has been funneling significant portions of their joint income into a secondary life that Sophia knew nothing about. This included high-stakes gambling, the financial support of a non-marital relationship, and the quiet acquisition of a condominium in another state titled under a shell corporation. In 2026, the detection of these parallel lives relies on the forensic reconstruction of the marital cash flow. The legal standard for dissipation is strict. It is not enough to show that a spouse spent money foolishly. The petitioner must show that the funds were spent for a non-marital purpose while the marriage was failing. Historical trends in Florida and Illinois case law suggest that the burden of proof initially rests on the spouse alleging the waste. Once a prima facie case is made, meaning enough evidence is presented to raise a serious question, the burden shifts to the spending spouse to prove, by clear and convincing evidence, that the expenditures were for legitimate marital expenses. For Sophia, the first step is the expenditure audit. This involves a day-by-day analysis of credit card statements, Venmo logs, and cash withdrawals over the 24 months preceding the filing. Forensic accountants look for the lifestyle gap. If Robert's reported income and the family's visible expenses don't align with the remaining bank balances, the money has gone somewhere. In the case of a secondary family or relationship, this often appears as repetitive lifestyle maintenance payments, rent for an undisclosed apartment, duplicate grocery bills, or unexplained travel expenses. Academic researchers categorize these as maintenance dissipation. A more complex form is asset shifting. Robert might have used marital funds to pay down the mortgage on a property he inherited, which he claims is his separate property. By using marital income to increase the equity in a separate asset, he has engaged in a form of dissipation that the court can remedy through a reimbursement claim. Step by step, Sophia's legal team must calculate the exact amount of marital fruit used to nourish the separate tree. In 2026, courts increasingly use the inception of title rule versus the source of funds rule to decide how much of that property Sophia is entitled to. Then we have the shadow debt. Imagine if Sophia discovers that Robert has taken out a home equity line of credit or a secret business loan, totaling $200,000, and the funds have vanished. In the academic study of debt allocation, this is known as non-matrimonial liability. While most marital debt is shared, a debt incurred for a purpose that did not benefit the marriage, such as funding a gambling addiction or a secret business venture that failed, can be assigned solely to the spouse who incurred it. Case studies from 2026 show that the key to winning this argument is timing. If the debt was incurred in the shadow of divorce, courts are far more likely to view it as an attempt to reduce the net marital estate. Furthermore, we must address the long-term exit plan. This is a strategic, often multi-year process where one spouse slowly leaches assets out of the marital pot in anticipation of a split. This might involve overpaying the IRS to trigger a large refund that will arrive after the divorce is final, or deferring a year-end bonus until the following fiscal year. Academic discourse calls this income manipulation. To counter this, Sophia's experts must look at the historical earning pattern. If Robert's income suddenly dropped by 40% the year he decided to leave, but his industry is booming in 2026, the court may impute income to him. Imputation is a legal fiction where the court treats a spouse as if they are still earning their former high salary for the purposes of calculating support and asset division. We also need to consider the role of digital dissipation. In 2026, this includes the purchase of virtual assets, online gaming currencies, or subscriptions to adult content platforms. While the dollar amounts per transaction may be small, the aggregate over several years can be staggering. Sociological data suggests that microtransactions are one of the most common ways spouses hide the true extent of their discretionary spending. A forensic audit of digital wallets often reveals a trail of breadcrumbs leading to larger, undisclosed accounts. The parallel life scenario also introduces the concept of intervening third parties. If Robert gifted a luxury vehicle or a diamond watch to someone outside the marriage using joint funds, Sophia can bring a fraudulent transfer claim. In some U.S. jurisdictions, the court has the power to join that third party to the divorce lawsuit to claw back the asset. This is a high-stakes legal maneuver that requires specific evidence of intent to defraud the marital estate. It is not just about the money, it is about the integrity of the estate. As we analyze these secret estates, we must look at the psychological impact of financial betrayal. Academic researchers have found that women who discover financial infidelity often experience a form of betrayal trauma that can cloud their legal judgment. The strategy for Sophia must be to separate the emotional shock from the tactical response. The goal is a judgment for dissipation, which results in an unequal distribution of the remaining assets to make Sophia whole. If $100,000 was wasted, the court doesn't just give Sophia $50,000. They may award her the first $100,000 of the remaining house equity before the 50-50 split even begins. This part of the masterclass highlights that the truth in a 2026 divorce is often hidden in the ledgers of a secret life. For Sophia, the potential outcomes of her case depend on her ability to turn suspicion into admissible evidence. We have moved from the visible assets to the invisible future, and now into the dark corners of the secret estate. But even with all the evidence in the world, the final result is often decided in a room where the rules are different and the pressure is higher than in any courtroom. What happens when the discovery is over and the negotiation begins? What are the high-stakes settlement tactics used by the top 1% of divorce attorneys to force a deal? In the next part, we will explore the game theory of divorce settlements. We will deep dive into the brinkmanship strategy, the midnight offer, and the psychological anchoring techniques used to make you walk away from the table with less than you deserve. The most dangerous moment in your divorce isn't the filing. It's the final 5 minutes of mediation. We are entering the endgame. The endgame of a high-stakes U.S. divorce is governed by the principles of game theory, where the resolution of a multi-year conflict often hinges on a single afternoon of intense negotiation. In the academic discourse of alternative dispute resolution, this is known as the zone of possible agreement. To navigate this final hurdle, imagine a woman named Isabella in Denver, Colorado in 2026. Isabella has spent 18 months in litigation. The discovery is complete. The forensic accountants have issued their reports, and the trial date is set for next month. She is now entering a mandatory mediation session. In this environment, the legal facts remain the same, but the psychological leverage shifts. The most common historical trend in these sessions is the use of psychological anchoring. Anchoring occurs when one party makes an opening offer that is intentionally extreme. If Isabella's spouse, David, opens by suggesting he should keep 60% of the marital assets because he was the primary earner, he is setting a mental anchor. Even if the law in Colorado suggests a 50-50 split is the likely outcome, David's extreme starting point forces the entire conversation to happen in the space between 60% and 50%. Academic researchers have found that the first number mentioned in a negotiation exerts a powerful pull on the final result. For Isabella, the counter-strategy is not to move toward David's anchor, but to re-anchor the conversation with an equally evidence-based proposal from her side. If she counters with 60% for herself based on her need for rehabilitative support and his proven dissipation of assets, she effectively resets the center of the negotiation. We must also analyze the brinkmanship strategy. Brinkmanship is the practice of pushing a situation to the verge of disaster to force the other party to blink. In a 2026 divorce context, this often takes the form of the trial threat. David's legal team might present a settlement offer and state that it is their final, best offer. And if Isabella does not sign by 5 p.m., they will withdraw all concessions and go to trial. This creates a high-pressure environment designed to trigger Isabella's risk aversion. Historical case studies show that trials are unpredictable, expensive, and public. David is betting that Isabella's fear of the unknown in a courtroom will outweigh her desire for a better deal. The academic defense against brinkmanship is a thorough BATNA analysis. BATNA stands for Best Alternative to a Negotiated Agreement. Before Isabella enters the room, she must know exactly what the most likely outcome at trial will be. If her BATNA is better than David's final offer, the threat of trial loses its power. Another sophisticated tactic is the midnight offer, or exploding offer. This happens at the end of a long, exhausting day of mediation, when the parties are physically and emotionally depleted. The mediator walks into Isabella's room and says, "David will give you the house and the full pension, but only if you sign right now. If you leave this building without signing, the deal is off." Sociologists call this decision fatigue. When the brain is exhausted, its ability to process complex financial trade-offs diminishes, and the desire for closure becomes a powerful biological drive. Case studies from 2026 indicate that many of the most disadvantageous settlements for women are signed in the final 30 minutes of a 12-hour mediation session. The step-by-step defense is to insist on a review period. A strategic negotiator never signs a final binding agreement under duress at 2 a.m. They agree to the Memorandum of Understanding, with the caveat that it is subject to a final review by their financial advisor or tax expert the following morning. We also have to discuss the good cop, bad cop dynamic between the opposing attorney and their client. David might act as if he wants to be reasonable and fair, for the sake of the children, while his attorney takes a hyper-aggressive stance, making unreasonable demands and insulting Isabella's contributions. This is a coordinated psychological play, designed to make Isabella view David as her ally, and his attorney as the only obstacle. If she falls for this, she might find herself communicating directly with David, who then manipulates her into making concessions that her own legal team would never advise. Academic discourse emphasizes that in the endgame, all communication must be professionalized. The friendly spouse is often just as strategically aligned with the aggressive attorney as a CEO is with their lead negotiator. Furthermore, we must address the salami slicing technique. This involves reaching an agreement on the big issues, like the house and the custody schedule, and then slowly slicing away at the smaller assets. David might agree to the 50-50 split of the house equity but then demand all the furniture, the frequent flyer miles, the season tickets, and the tax refunds. While each item seems small in isolation, the aggregate value can be worth tens of thousands of dollars. Historical trends suggest that by the time the small items are discussed, the woman is so relieved to have the big issues settled that she gives them away just to be done. A masterclass approach requires a global settlement view. No issue is settled until every issue is settled. You do not agree to the house without also agreeing to the division of the retirement and the allocation of the 2026 tax liabilities. A critical part of the game theory in 2026 is the tax indemnification clause. In the final minutes of a settlement, the focus is often on the division of current cash. However, a savvy opposing counsel might slip in language that makes Isabella responsible for any future audits of their joint tax returns from the last 3 years. If Isabella signs this without a reciprocal indemnification or a hold harmless agreement, she could be hit with a massive IRS bill in 2028 for Michael's previous business addbacks that we discussed in Part 5. This is the tale of the divorce that can wag the dog for years to come. Then there is the Qualified Domestic Relations Order, or QDRO timing. In the endgame, the settlement might say Isabella gets 50% of the 401k. But if the language does not specify that she also gets the earnings and losses on that 50% from the date of the agreement until the date the funds are actually transferred, she could lose out on a market upswing. In a volatile 2026 economy, a 3-month delay in filing the QDRO could cost her 5 figures in lost growth. High-level strategy requires that the QDRO be drafted and approved by the plan administrator before the final judgment is signed, ensuring that there are no technical errors that allow the spouse to block the transfer later. Isabella's potential outcomes in the endgame are determined by her ability to withstand the pressure of the finish line. The data shows that the party who is most willing to walk away from the table and go to trial usually secures the better settlement. This is the paradox of divorce negotiation. To avoid a trial, you must be visibly and intellectually prepared to win one. The final 5 minutes of mediation are not about the law, they are about the perception of resolve. As the ink dries on the settlement agreement, many women feel a sense of overwhelming relief. They believe the battle is over. But in the academic discourse of domestic relations, a new and equally complex phase is just beginning. The settlement is just a piece of paper. The implementation is where the actual wealth is secured. What happens when your former spouse refuses to sign the deed? What happens when the automated support payments fail in the banking system of 2027? In the next part, we will explore the post-decree minefield. We will deep dive into the mechanics of enforcement, contempt of court, and the asset transfer checklist that ensures your settlement actually lands in your bank account. The deal is signed, but the money isn't yours yet. We are moving into the era of enforcement. The transition from a signed settlement to the actual receipt of funds is what academics in domestic relations law call the execution gap. In the legal systems of the United States, a judgment of dissolution is a powerful document, but it is not self-executing. It is essentially a court order that requires the parties to perform specific actions. If those actions are not taken, the document remains a collection of unenforceable promises. To understand the mechanics of this phase, imagine a woman named Taylor in Charlotte, North Carolina, in late 2026. Taylor has a final decree stating she is to receive $400,000 from her former husband's brokerage account, a deed to the marital home, and monthly spousal support of $5,000. However, 3 months post-divorce, the brokerage firm has not received the paperwork, the deed has not been recorded, and the first support check was partial and late. Taylor has entered the post-decree minefield. The first line of defense in the era of enforcement is the specific performance timeline. Academic discourse suggests that a well-drafted settlement should include a drop-dead date for every transfer. For instance, the decree should state that the husband shall execute the quitclaim deed within 14 days of the entry of judgment. Without these specific deadlines, a recalcitrant spouse can claim they intend to comply but are simply busy, leading to months of stagnation. Historical trends in state courts show that judges are far more likely to issue a contempt citation when a clear, unambiguous deadline has been missed. When deadlines are ignored, the primary legal tool is the motion for contempt or an order to show cause. In the U.S. legal system, contempt of court occurs when a party willfully violates a clear and specific court order. There are 2 types: civil and criminal. Civil contempt is remedial, meaning the court uses it to coerce the party into obeying the order, often through fines that accrue daily until the task is completed. Criminal contempt is punitive, meant to punish the party for the act of disobedience itself. Case studies from 2026 indicate that the mere filing of a contempt motion often acts as a catalyst for compliance, as the non-compliant spouse realizes that the court's patience has reached its limit. However, Taylor must be prepared for the burden of proof. She must demonstrate that a valid order existed, that the former spouse had knowledge of the order, and that they had the ability to comply but chose not to. If the former husband claims he cannot pay the $400,000 because the brokerage account lost value in a market dip, Taylor's forensic accountant must return to prove the funds were diverted, or that the loss does not excuse the underlying obligation. This is why the liquidated damages clause is becoming a staple in high-level academic legal strategy. This clause stipulates that if a payment is late, a specific interest rate or penalty is automatically applied, removing the need for a separate hearing to determine damages. Step by step, the asset transfer checklist is the operational manual for this phase. First, the Qualified Domestic Relations Order, or QDRO, which we discussed in previous parts, must be served on the plan administrator. Taylor should not rely on her former spouse to do this. Her own legal team must ensure the administrator has pre-approved the draft, so that the transfer happens without technical friction. Second, the quitclaim deed must be signed and, crucially, recorded with the county recorder of deeds. Simply holding the signed paper is insufficient. Until it is recorded, the former spouse could theoretically still attempt to take a loan out against the property. Third, the life insurance policy must be updated. If the decree requires the former spouse to maintain a policy to secure alimony or child support, Taylor must be listed as the irrevocable beneficiary. Academic research shows that without the irrevocable designation, the owner of the policy can change the beneficiary the day after the divorce is final without Taylor ever being notified by the insurance company. Now let us examine the support enforcement infrastructure. In 2026, many U.S. states utilize an income withholding order, or IWO. This is a direct order to the former spouse's employer to deduct support payments directly from their paycheck and send them to a state disbursement unit. This removes the human element and the potential for monthly power struggles. For women like Taylor, whose former spouses may be self-employed or work as independent contractors, the IWO is less effective. In these cases, the academic strategy shifts to asset liens. If a support payment is significantly past due, Taylor can petition the court to place a lien on the former spouse's non-exempt property, such as a second car or a boat. If the property is sold, the past due support is paid first out of the proceeds. A significant historical trend in 2026 is the interception of federal payments. Under federal law, state child support agencies can coordinate with the Department of the Treasury to intercept tax refunds, Social Security benefits, and even federal salary payments of individuals who owe significant arrears. While this process is often slow, it provides a powerful backstop for long-term enforcement. Academic data suggests that the success rate of collections increases by over 40% when these administrative remedies are utilized alongside traditional court motions. Then we have the cyber asset transfer. As we noted in Part 6, if the settlement involves cryptocurrency, the enforcement becomes a technical challenge. If the former spouse claims they lost the private keys to a digital wallet containing $100,000 of Taylor's settlement, the court faces a difficult evidentiary hurdle. The countermove in 2026 is the asset value conversion clause. This allows Taylor to request that the court convert the digital asset obligation into a fixed US dollar judgment if the transfer is not completed within 48 hours. This allows her to pursue traditional collection methods, like garnishing a bank account, rather than chasing a ghost in the blockchain. We must also address the international enforcement barrier. If a former spouse moves out of the United States to avoid their financial obligations, Taylor's legal path becomes significantly more complex. The academic discourse here focuses on the Hague Convention on the International Recovery of Child Support and other forms of family maintenance. As of 2026, dozens of countries have ratified this treaty, allowing for the cross-border enforcement of support orders. However, for property settlements, the process often requires filing a new lawsuit in the foreign jurisdiction to domesticate the U.S. judgment, a process that can be both expensive and time-consuming. Case studies in post-decree litigation highlight the death of a party risk. If the former spouse passes away before the property transfer is complete, Taylor's claim moves from family court to probate court. In probate, she is no longer a spouse but a creditor of the estate. Academic strategy dictates that the divorce decree should explicitly state that its terms are binding upon the heirs, executors, and assigns of the parties. This ensures that the estate cannot argue the obligation died with the individual. As Taylor systematically checks off her list, she moves from the vulnerability of a legal winner to the security of a financial holder. She learns that the end of the divorce is not the day the judge bangs the gavel, but the day the last dollar clears her personal bank account. This realization is the final bridge between the academic study of law and the practical reality of survival. But as the financial dust settles and the bank accounts are finally partitioned, a final deeper question remains. Once the assets are secure and the legal battles are won, how do you rebuild the economic identity of a woman in the wake of a systemic shift? In the final part of this masterclass, we will explore the sociology of the post-divorce future. We will deep dive into the data on wealth longevity, the legacy planning of the independent woman, and the academic framework for ensuring that the hard-won settlement of 2026 becomes a multi-generational foundation. The masterclass concludes with the blueprint for what comes after the war. The academic discourse surrounding the post-divorce future for women in the United States has shifted from a narrative of deficit to one of strategic reconstruction. In this final chapter of our masterclass, we examine the sociological and economic framework of the newly independent estate. Imagine a woman named Catherine in Atlanta, Georgia. In late 2026, the litigation is a memory, the assets have been transferred, and the enforcement phase is complete. Catherine now sits atop a restructured balance sheet that represents not just a settlement, but the seed capital for the rest of her life. The challenge she faces is what researchers call the longevity of wealth. Historical trends indicate that women, on average, outlive men by several years, meaning Catherine's settlement must be engineered to last decades longer than that of her former spouse. This requires a transition from the defensive posture of litigation to the offensive posture of legacy planning. The first pillar of this transition is the recalibration of risk tolerance. During a divorce, the focus is often on liquidity and preservation, having the cash to pay attorneys and the stability to maintain a household. In the post-divorce era, Catherine must pivot toward growth-oriented academic strategies. Step by step, this begins with a comprehensive audit of the cost basis. As we discussed in Part 3, the tax characteristics of the assets Catherine received will dictate her future cash flow. If her portfolio is heavy in low-basis stock, she must develop a multi-year exit strategy to diversify those holdings without triggering a massive capital gains event in a single tax year. Academic financial models suggest that tax loss harvesting and the strategic use of charitable remainder trusts can be utilized to move wealth into more stable, income-producing vehicles while mitigating the impact of the 2026 tax brackets. Furthermore, we must address the credit identity restoration. For many women in the U.S., particularly those in long-term marriages where the spouse managed the primary financial accounts, their individual credit score may have been stagnant or secondary. In 2026, a credit score is more than just a number for a loan. It is a metric used by insurance companies, landlords, and even some employers. Catherine's strategy involves the immediate establishment of independent credit lines, the monitoring of zombie debts from the marriage that might resurface, and the use of secured instruments if necessary to accelerate the rebuilding process. Historical case studies show that women who proactively manage their credit identity within the first 12 months post-divorce see a significant increase in their overall financial mobility. We then move into the sociology of the solo household. The data shows that the overhead of a single-person household is statistically higher per capita than a joint household. This is the singles tax. To counter this, academic discourse emphasizes the lean infrastructure model. This isn't about austerity. It's about the efficient allocation of the settlement. For Catherine, this might mean right-sizing her real estate. If she kept the 5-bedroom family home, she must analyze the carrying costs, property taxes, maintenance, and insurance against the potential for a smaller, more modern residence that offers better appreciation and lower utility costs in the 2026 energy market. The next layer is human capital reinvestment. As noted in earlier parts, the divorce settlement often accounts for past contributions, but Catherine's future depends on her current earning capacity. Academic researchers have identified the reskilling dividend. Women who use a portion of their settlement to obtain advanced certifications or to pivot into high-growth sectors like digital healthcare or renewable energy management often see a potential outcome of significantly higher lifetime earnings compared to those who remain in stagnant roles. In 2026, the cost of education is an investment in the most resilient asset Catherine owns, herself. We must also explore the estate planning reset. A divorce decree does not automatically update a will, a power of attorney, or a healthcare directive. Case studies are littered with accidental beneficiaries, where a former spouse receives a payout because a woman forgot to update a POD or payable on death designation on a bank account. Catherine's blueprint for the future requires a clean slate legal audit. This includes the creation of a revocable living trust, which allows her assets to pass to her children or chosen heirs without the public and costly process of probate. In the academic study of wealth transfer, the trust model is the gold standard for protecting the privacy and the principle of an independent woman's estate. Beyond the numbers, we must address the social capital shift. Sociologists have found that divorce often results in a network contraction. Catherine may lose access to professional or social circles that were tied to her marriage. The strategic countermove is the intentional curation of a new support system. This includes professional advisors, a CPA, a CFP, and a therapist, but also a peer network of other independent women who are navigating similar transitions. This social infrastructure provides the emotional resilience needed to make high-stakes financial decisions without the cloud of settlement fatigue. Now, consider the legacy planning for the next generation. If Catherine has children, Her post-divorce strategy must include the educational funding gap. In 2026, the cost of higher education continues to outpace inflation. While the divorce decree may have specified contributions toward college, those amounts are often baselines. Catherine's independent planning involves the use of 529 plans or uniform transfers to Minors Act accounts to ensure that her children's future is not dependent on the continued cooperation of her former spouse. This is the decoupling of her children's security from the volatility of her former relationship. As we reach the conclusion of this masterclass, we must look at the macroeconomic resilience of the woman in 2026. The world is changing rapidly, with shifts in AI, global markets, and domestic policy. Catherine's success is not found in a static bank balance, but in her adaptive capacity. This means having a laddered investment strategy that provides liquidity for today, growth for tomorrow, and a legacy for the future. The academic discourse reminds us that divorce is an ending, yes, but in the structural sense, it is the demolition of an old building to make way for a skyscraper. The blueprint for what comes after the war is built on 3 words: clarity, agency, and sovereignty. Clarity of the data, agency over the decisions, and sovereignty over the future. Catherine is no longer a party in a lawsuit. She is the chief executive officer of her own life. The potential outcomes of her journey are now hers to define, guided by the deep dive strategies we have dissected over these 10 parts. But even with the blueprint in hand, the path of the independent woman in the US is constantly evolving. New laws will be written, new tax codes will emerge, and new social norms will take root. While this masterclass concludes here, the discourse never truly ends. The question for the viewer today is not just how to survive the dissolution, but how to thrive in the vacuum it leaves behind. As the landscape of American family law continues to shift, staying informed is the only way to remain empowered. What will the modern woman's estate look like in 2030? How will the rise of post-divorce cohabitation agreements and independent wealth pods change the way we view the single household? The era of the nuclear family is giving way to the era of the strategic individual. Our investigation into the academic and legal structures of the US may be closing for now, but the rise of the independent estate is just beginning. Stay tuned as we continue to track the socio-economic evolution of the American landscape. Your new life is not a happy accident. It is a meticulously engineered masterpiece.